Okay, now all these tools here were pretty much all focusing on cash inflows, besides the second rate of return, which we focus on operating income. Operating income is actually an accrual accounting tool. Remember the idea of accrual accounting? In financial accounting, we talked about the difference between accrual accounting and cash-based accounting, right? So accrual accounting links to the concept that we may have accounts receivable, which is not cash yet, but we still consider it as asset. Accounts payable, not actual cash payment yet, but we still consider it as liability, right? So for all these four tools, only the second one we refer to accrual accounting based, operating income. All the remaining first, third, and fourth, just to give you a heads up, it's focusing on cash inflows, cash outflows. The differences between the cost that we're saving, the cash that we're receiving, against any operating expenses that we're spending. The differences we call the net cash inflows. Okay, so if we update the website, what is the potential revenue that we're getting from that? As customers are better able to see our products from the updated website. They can do more purchases. What is the projected sales revenue increase there? That's the cash inflows. But what about the people that we hire to maintain the website? Are we spending additional labor cost on this? So the differences between the inflow and outflow, we call it a highlighted term, net cash inflows. That's actually the base for most of the analysis we'll be doing a little bit later. Okay, now, so the main difference between net cash inflows and the operating income basically falls under depreciation expenses. So remember that assets, we usually measure how long it can be used in the business, and we may be depreciating it by a straight line method, typically for furnitures, for buildings. Some of the machines, if it helps us manufacture certain products, we may be depreciating it by units of production, right? So depreciation expense is really not a cash that we're spending or paying anybody. It's just a measure of degrading the value of assets. Okay, so at this point, keep this in mind because later when we go over some of the tools, sometimes we use operating income, sometimes we use net cash flow. The differences between these two really is just the depreciation expense. Operating income is an accounting measurement, so we usually consider depreciation expense in this. We minus depreciation from net cash inflow. Okay, so this is just pointing out, reviewing some of the concept differences that you learn in financial accounting. Probably it's a little blur right now. Just keep in mind that cash inflow, outflow doesn't represent the accrual accounting income and expenses. Remember that depreciation expense also factors in operating income. Okay, so this is the inflow, the cash revenue that we're receiving, but we also have expenses that we usually depreciate every single month, especially on long-term assets. That will reduce the inflow, become operating income later. But mostly, generally speaking, all the four tools besides the second one, rate of return, we're using operating income. All the other ones we're focusing on cash inflow, outflow. What is really the present value of the return that we're getting from investing in these long-term projects.